Oliver Wyman provides management consulting, strategic advisory, and risk management frameworks to help traditional financial institutions, governments, and crypto native firms safely integrate blockchain and digital assets. In the latest installment of our series, Markets on Chain with GBBC Digital Media, we welcome Michael Wagner, partner at Oliver Wyman. Great to have you here.
Thank you for having me.
So set the stage for us. And what does Oliver Wyman and the Global Blockchain Business Council do together? And I understand you lead the capital markets risk mitigation framework alongside some leading financial institutions and blockchain infrastructure. Explain that partnership and how that's working.
Yeah, so when we started engaging, we're a member of GBBC, so we've been in the dialogue for quite a while. And one of the things became obvious is that as firms were implementing blockchains, and banks and other financial institutions wanted to use blockchain, there wasn't really a deep understanding among supervisors or even some of the financial institutions how this would fit within the existing risk mitigation or risk management framework. So and we looked around and thought, is there nothing that people could use? And there were bits and pieces, but there wasn't really a cohesive framework that would allow either a supervisor or a bank to implement it within their existing kind of risk and compliance frameworks. And the idea really was, why don't we develop something with the largest financial institutions, exchanges, or FMIs, right? And also the blockchain native firms to basically give a deep understanding how these risks could actually be mitigated and ultimately managed.
Okay, so what did that look like and what has it addressed so far? What have you learned from that?
Yeah, so we formed a working group, as one does in these things. So we brought together about 10 firms that both had experience in blockchain, but also had the traditional finance experience, plus some of the chains themselves, because we wanted to make sure that everything we cover really is rooted in the depth of the technology and of the firms that operate those technologies. So we brought, I think there was, 10 firms, roughly a third in terms of contributions to all of these three pieces.
Okay. And what have you come up with any conclusions or where are you with that?
Yeah, so what we developed this in stages. So the first thing we did, we looked at the layer one blockchain. So these are the underlying infrastructure of the blockchain, and basically looked at the risk mitigation issues there and developed the framework to start with that, which I would call the foundation. So that's the foundational framework which we developed throughout until the summer last year. So it was published in July last year, was open for comments, right? So it's open to the public, so people can access it from the GBBC's website, from our website, in order to start the thought process. We then looked at the layer two. So these are blockchain infrastructures that are basically built on these foundational layers, and looked at, is there anything different? Is there additional risks or additional issues that firms would need to understand and manage, right? And then we basically looked at applications. Because we had some of the largest FMIs as part of the contributors, they wanted to look at tokenized securities. So we looked at, how do you handle applications of these blockchains in very specific cases. So we did tokenized securities, and we are now going to publish liability tokens, i.e. stablecoins or tokenized deposits.
Okay. Well, that'll be interesting to read and see what you came up with there with the publishing of that.
Yeah, no, I think a lot of firms are using it to inform their own efforts to implement the controls mechanisms for blockchains, because as institutions are implementing it, they need to demonstrate that they can manage the risk, that they are resilient, or that whatever the processes they're putting in place is resilient, and therefore it can be adopted as a broad infrastructure for the entire financial system. So the main reason really is, if you want to run a financial system on a blockchain, you have to be sure that all the eventualities can be addressed.
Absolutely. Now, you also partner with some of your clients, like JP Morgan's Onyx, on research papers. What have you learned from those?
Yeah, I think those are addressing very specific product issues. So, for example, Onyx was really tokenized deposits. I think the interesting part there was there wasn't really that much understanding in the broader market of what this product is and what it can do. So part of it is education. So the foundational piece really was to educate people. What are the different building blocks of a tokenized deposit in this case, right? We then looked at how do you adopt this? We talked to clients, right? And the feedback from clients kind of was, we love the blockchain and we see the efficiency it will bring and everything, but we don't really want to involve ourselves in the mechanics. So JP Morgan as a company or any bank as a company needs to make it easy for the users or the end users to adopt, right? Because I said, we're not changing our business processes. We don't really want to make a major investment in reconfiguring our core databases and all of that, but we see the value in the specific product, specifically in cross-border payments. So therefore, you need to make it easy for us to adopt.
Okay. That's really interesting, because my next question was going to be, what are you seeing in terms of adoption by financial institutions? I feel like this year we've really made some significant progress when it comes to tokenization. So what are you seeing on the front lines?
Yeah, we see a lot of people wanting to get ready. So I think the financial institutions were caught a little bit out of turn because they did do a lot of experimentation 2016, 17, 18, but then concluded that they weren't really going to go in deep into the technology. So they basically had groups that were looking at it, monitoring it, but nobody's really developed the business processes or wanted to scale this. So I think the biggest learning is that firms now really have to look at, how do we scale this technology? How do we develop capabilities that will allow us to work with this technology at scale? And that's where I would see the biggest sticking point. It is kind of like, one is the risk and compliance management that the RMF covers, but others is also talent. You have to find people that understand the blockchains. And, given the crypto winter and given the development, there is a dearth of talent. And also, to be frank, a lot of talent walked off into AI.
Okay.
So I think
I've heard that.
no. So it's not so straightforward to adopt the technology because there isn't that much talent out there, but or applications that you could just plug in. But that is, I think, what is now starting to change. So major companies like the DTCC are launching their own tokenization frameworks, making it easier for the industry to adopt blockchains and blockchain processes.
Yeah, they had that event in July, which looked to be a success, and another one coming up. So what are the challenges that remain? You've outlined some of them. I know we're kind of waiting on some legislation out of Washington. What do you see as the challenges still?
So I think, as I said, it's a new technology. Ultimately, it brings a huge amount of benefits, but you have to kind of like implement the entire chain from sort of the business process from the beginning to the end, ideally needs to be addressed to get the full benefit. So I think it's realizing that benefit, creating ecosystems that are actually happy to run major processes on chain, and therefore to realize that end-to-end benefit for clients and participants.
Do you see companies doing it, maybe one division, kind of testing it out there, or a smaller entity? Like, how do you see that kind of evolving?
Yeah, so I think the large traditional finance companies are choosing a product area, right? So because they did experimentations, and many had these experimental units in the center that just played with the technology to understand what the technology can do. What's now really happening is it's going mainstream, right? With the legislative support, because we had a lot of support already to adopt the new technology, like the SEC and other agencies really have embraced the technology as a way to modernize the financial system, right? With that, I think now the road is there to adopt it into products. So people are looking at either the deposit token, like the Onyx product we talked about, or at the security side, which is securities trading centered around the DTCC innovation. So most companies today are really embedding this in their businesses. So either the payments business or the securities business. And they're looking at very specific use cases that are high value for them. Like, for example, collateral is a big balance sheet, potentially brings a big balance sheet relief that these companies would want to realize, and their clients also. So that's where the business cases are positive, and that's kind of where the activity is clustered around for now.
Okay. Now, in stable coins, what role are they playing in all of this? And is that whole system resilient enough to be reliable yet?
I think stable coins are very interesting because they're actually pushing the adoptions in payments. So banks are worried that through stable coins, the deposits will be rendered less valuable, right? So banks are the major deposit gathering, and therefore stable coins are providing an alternative, right? Because it's usually treasury backed or high quality backed. So I have a very high quality asset that I can program and that I can essentially use in the form of a stablecoin as a payment mechanism without having to touch any bank or financial institution. I'd have to be a payment institution, but I can make this whole process bankless if I want to, right? So this brings, I think, a huge benefit to merchants who are looking to experiment. I mean, I brought up agentic AI, so agentic payments are very interesting in this. So that is kind of where a lot of the focus is right now, because essentially blockchains provide financial assets that are programmable. And agentic provides the input to program these assets. So therefore, provide a huge benefit potentially to consumers, but also to financial intermediaries or other participants to manage their payments, their liquidity needs, and other kind of payment needs.
Yeah, no, fascinating. The agents will just be paying each other and we won't even see it. I guess at some point, maybe.
Well, there is a thing that the stock exchange also has. It's a kill switch. I think you do need the kill switch for.
There's been more talk about that. Actually, it kills, especially given some of the hacks that we've seen lately. With AI. So in terms of digital supply chains, what are you seeing there? Is that streamlining the process of getting goods to market, maybe even reducing the cost for the end user?
Yes, I think supply chains are very complex and are very costly to intermediate. So you have these specific instruments like bills of lading, letters of credit, or factoring, all of these things. They generally relatively expensive tools for a company to use, because the problem is I can't observe where the asset is or where in the process the whole financing chain is, right? Blockchains really allow a few benefits. They allow observability. So I can see where in the process the payment is, or even the good, but the good needs to be coupled with an observation of where the physical assets are. But I can observe where the contract is moving. I can observe with stablecoins also where the payments are moving. I can ascertain whether somebody has the funds to pay, which is a specific issue when you do cross-border in
Oh,
exports,
that's really interesting. So
because
you know that they have the money before.
you know that they have the money, that they are good for the money, so you could lock them up or lock the money up, and then basically wait for the shipment to arrive. The other thing I think is you have a seamless audit trail, so you can basically see who who has signed for it, who has passed this on. So in a trusted environment that we already have, like a shipping chain or a supply chain financing chain, the intermediaries are known, and even the individuals that sign for it. And perhaps with digital identity, we can even advance this further. You can basically automate the process, and the asset basically becomes a more available, abundant financial assets, because most of or a lot of IMN exports are still just financed through the balance sheets of the corporations. This could make these assets available for investment. And we know that large hedge funds already do this for very large shipments like oil, but the blockchain could make this available for smaller shipments and smaller payments.
So those are some advantages to blockchain for companies to add to their system. Are there any others we haven't talked about? And then also, what does this mean for the average person? How will they benefit from companies implementing blockchain?
I would say the average person will hopefully get cheaper intermediation costs, because one of the things that blockchain allows, so this observability and certification kind of feature, it allows basically the elimination of intermediaries. Like, for example, in the payment system today in cross-border, we have many correspondent banks, and they all need to be compensated for the processes, but also for the risk intermediation that they provide, right? So they provide the balance sheet to ensure that the payer in country A is a reliable payer to a bank or to a end client in country B. So all of this through the blockchain can actually be condensed into a much more efficient process, which should also be a lot cheaper, because when you have balance sheets involved and or institutions with processes that have to be very high quality and very resilient, if you can eliminate intermediaries, you will basically have a much higher benefit to the end clients.
Okay.
So I'm not sure whether the retail customer necessarily will benefit from it, but corporations and companies servicing retail customers for sure will.
Yeah, and I would think the end user would benefit from some lower prices just because the whole process is
Yeah.
streamlined and more transparent, and perhaps that could help with inflation.
Yeah, and the other thing that blockchains bring is a global infrastructure that is there. So it's a pay-as-you-go infrastructure. So permissionless systems, like open systems, like Bitcoin, Ethereum, or any of those, actually provide access to anybody that in any country globally that wants to access it. Now that comes with risk as well, but it does come with the promise of being able to access the system for transactions globally and access anybody globally through the system, which is something which we really never had before.
Okay, Michael Wagner of Oliver Wyman, thank you so much for being part of our Markets on Chain series with GBBC Digital Media.
Thank you so much, Shay.